The classic idea that I think a lot of lawmakers might have in mind is that someone has a full-time, full-year job, they get one earnings statement at the end of the year from that employer, and then they take that to their tax return preparer, and all is good. But that's just not the reality anymore. And so we wanted to delve into the question of how are incomes bouncing around, and what impact might this have on people's ability to properly predict their taxes. An earned income tax credit for many people is the most significant financial event of the year. The earned income tax credit lifts more people out of poverty than any other government program. We found that incomes are much more volatile than we had ever anticipated. 64% of all low-income households experience at least 1 month of the year where their income deviates by 25%, either higher than the average or lower than the average. There's sort of two phenomena happening with low-income families. The first is that their families are changing. We've seen a rise in cohabitation, which means two adults are living together. They may or may not both be related to the children that live with them. We've also observed more cases, particularly for low-income families, where you have a multi-generational household, and that means you have grandma who might be taking care of a grandchild, and a parent of that child might be in the household as well. All of these complicate tax filing. Layer on to that, the nature of work for low-income families has changed. You're much more likely, if you're low income, to be moving in and out of jobs. If families are provided the documents that the IRS is looking for, it makes tax filing much easier. The second thing we always talk about is when Congress passes laws, they need to ask, is it reasonable that people will have this information? And to the extent the information is difficult to collect, we shouldn't be creating laws based on it.